All right, hello everybody, and welcome to this live webinar on business combinations under common control. Now today we're going to briefly recap the discussion paper issued by the ISB and then give an overview of the initial feedback received. My name is Bruce Mackenzie and I'm an ISB board member. I'm joined today by Julia Fagina and Richard Brown from the ISB technical staff. Now to start off with, just a few housekeeping remarks. If you'd like to know more about the project, the discussion paper itself and all the supporting education materials are available on our website. Now, as with all our presentations, any views expressed today are the views of the presenters and may not necessarily be shared by the board or the IFRS Foundation. Now, during the session, you'll have the opportunity to ask questions. So please submit your questions in the Q&A section on your screen, and we'll pick these up as we go along and at the end of the presentation. We may not be able to answer every question asked, but we will attempt to group any similar questions and try and address them all in one go. Now, there are three main topics we're going to cover today. Firstly, we're going to look at which method to apply to a business combination under common control. Secondly, how to apply the acquisition method. And thirdly, how to apply the book value method. Now, with that, I hand it over to Richard to remind us of why the board is doing this project. Over to you, Rich.
Thanks, Bruce. Today, business combinations are covered by IFRS standards and reported using the acquisition method, which provides fair value information about business combinations. But business combinations under common control are not addressed by IFRS standards. So in practice, receiving companies use either the acquisition method or a book value method, which provides book value information. There isn't a single book value method specified in IFRS standards, and so there's actually a range of different book value methods that are used in practice today. The board's objective for this project is to ensure that useful information will be provided about business combinations under common control, but without imposing unnecessary costs on preparers. And we'll see later in the presentation how the board is suggesting to achieve that. The diagram that's on screen shows the type of transaction that we're talking about here today. So IT Co acquires Software Co from a private co. Both IT Co and Software Co are controlled by Holding Co before and after the transaction, so they are under common control. The project addresses reporting by the receiving company in a business combination under common control, which in our example is IT Co. The project's not looking to address the reporting by other parties, for example, the controlling party, Holding Co. Receiving companies can be listed or unlisted. They can be wholly owned, or they can have non-controlling shareholders as well as the controlling party. In this project, the board's focusing on the information needs of the non-controlling shareholders, the potential shareholders, and the lenders and other creditors of the receiving company, because those are the parties that have to rely on the receiving company's general purpose financial statements to meet their information needs.
Thanks, Rich. Now let's just take a pause there and look at some of the questions that we've had been submitted. Please remember you can submit questions using the Q&A function that's on the screen. Now, Rich, if I can just address one to you. I mean, a common question we get in this area is where the controlling party is also the shareholder of the receiving company. Now, in this scenario, they need to rely on the receiving company's financial statements, but corporate governance or potentially other legal requirements may preclude them accessing this information. Now, why is the board ignoring the informational needs of the controlling party?
Thanks, Bruce. So this is a very common question we do hear on this. The reason to not focus on the information needs of the controlling party is that nothing really changes at that controlling party level. They controlled the business before, they still do afterwards. And the book values for all of the combining entities will remain the same. They're already known by the controlling party and will continue to be used for consolidation purposes going forward. In most cases as well, the controlling party will have been involved in approving the transaction or even agreeing and kind of driving the transaction. So it would already have information about the transaction, and it wouldn't need to rely on general purpose financial statements to get information about the transaction.
Thanks, Rich. Another question I wanted to ask, I'm going to ask to Julia. In describing business combinations under common control, IFRS 3 refers to transitory control. Now, has the board considered this in this project? In other words, have they looked at transitory control as far as common control transactions go?
Thank you, Bruce. And that's another common question that we receive in this project. So what I would like to clarify here is that generally the scenarios, business combinations under common control, which are either preceded by an external acquisition or followed by an external sale of the combining companies. So those types of business combinations under common control are in the scope of the project. However, in developing the discussion paper, the board has not yet considered the notion of transitory control and whether and how the notion of transitory control should be clarified. So that's one issue that the board will consider in the next stage of the project.
Thanks, Julia. Let's move on to the next section now, but please do keep submitting questions in the Q&A box. Richard, can you please give us a recap of the board's views on when the acquisition method and when the book value method should be applied?
Absolutely. Thanks, Bruce. So the board concluded that one size does not fit all. So both the acquisition method and the book value method are appropriate in different circumstances. The acquisition method would generally apply when the receiving company has non-controlling shareholders. But as I pointed out earlier, the board's objective is to deliver better information about business combinations under common control without imposing unnecessary costs on preparers. So the board is suggesting special conditions for private companies, and then in all other cases, a book value method would apply. You're probably already familiar with the flowchart on screen, which summarizes the board's view for when each method should apply. A couple of key points to highlight. Firstly, that we start with that underlying principle of whether the combination has affected non-controlling shareholders in the receiving company. If it did, the acquisition method generally applies, but that's where this cost-benefit trade-off comes in. In the board's view, the benefits of applying the acquisition method will likely justify the costs for public companies because the non-controlling interest is likely to be fairly significant, which is why the acquisition method would then apply. But when the receiving company is privately held, then the non-controlling interest in some cases could be very small. It could be held by the receiving company's related parties. And so sometimes the benefits of the acquisition method probably won't justify the costs. So for those reasons, there's an exception and an exemption for private companies in the flowchart as well. And just to highlight that both the exception and the exemption are based on conditions that already exist in IFRS standards today. I'll now hand it over to Julia to talk you through some of the initial feedback that we're hearing on this area.
Thank you very much, Rich. And just before I talk through this feedback, I would like to emphasize that these is initial thoughts that we're hearing in the outreach activities. And of course, we have 2 more months to the consultation period. So we're looking forward to further feedback in the outreach activities. And of course, also your feedback in the comment letters. So with that, in terms of what we've been hearing so far, some stakeholders agree with the board's preliminary views on when each method should apply and agree for the reasons set out in the discussion paper. So they agree that neither the acquisition method or a book value method would be appropriate in all cases for all business combinations under common control. And they also agree that focusing on whether the transaction affects non-controlling shareholders is a good pragmatic way to draw the line. Now, some stakeholders agree with the board's overall approach directionally, but raise questions and comments on particular aspects of the board suggested model. So, for example, some stakeholders believe that public debt, not only public shares of the receiving company, should also trigger the use of the acquisition method. These stakeholders suggest that public debt holders have very similar information needs compared to non-controlling shareholders. And just to reassure everyone that this particular point we are exploring in our outreach with users of financial statements to better understand what information they need and why. Some stakeholders are unclear how complex financial instruments, for example, convertible debt or share options, would be treated under the board's suggested model. And the board has not yet considered complex cases in developing the discussion paper. The board only considered basic scenarios, but the board will consider those questions in the next stage of the project if, of course, the suggested model is retained. Some stakeholders suggest that focus on just non-controlling shareholders is not enough, and that other indicators should be considered in determining appropriate accounting treatment. So, for example, they suggest it's necessary to consider whether transaction price is fair. Now, Rich talked about special conditions for private companies, the exception for related parties, and the optional exemption. So some stakeholders question whether the related party exception for private companies is necessary or whether it is appropriate. So under that exemption, the receiving company would be applying a book value method if all non-controlling shareholders are the company's related parties. So some stakeholders point out that related parties may also need fair value information. Again, this is something the board will look at in the next stage of the project. And finally, some stakeholders question whether optional exemption suggested in the model is operational and whether it is appropriate. So they argue that if one shareholder objects to use of a book value method and that triggers the acquisition method for the receiving company, that might not achieve the appropriate cost-benefit balance. And so they suggest that perhaps the board should consider instead a significance threshold. So as I already pointed out, the board will consider all that feedback in the next stage of the project. And finally, there are some stakeholders who disagree with using two methods to account for business combinations under common control. So, for example, some stakeholders argue that a book value method should be applied in all cases, and they argue that book value information is useful for non-controlling shareholders. In contrast, some other stakeholders think that fair value information should be provided in more cases than suggested in the discussion paper. So, for example, in all pre-IPO scenarios. And in those latter cases, stakeholders tend to really advocate a so-called fresh start method, where all combining companies would be reflected at fair value rather than the acquisition method per se. And what we have observed that those views that we're hearing are often informed either by the previous local GAAP applied in the jurisdiction or by existing prevailing reporting practices. And so building on this last point, what we would like to do is just to recap why the board believes that the acquisition method should be applied when non-controlling shareholders are affected. So let's consider the following example. Holding company controls several private and publicly traded companies. Software Co., its wholly owned, privately held subsidiary, is a successful business that has created valuable software. Holding company wishes to raise capital and decides to move Software Co. from private co to publicly traded IT Co. So IT Co buys Software Co for cash at fair value. So in this scenario, as we have explained, because IT company has non-controlling shareholders, the board's view is that it should apply the acquisition method. So let's look at why the acquisition method provides better information to non-controlling shareholders than a book value method. So let's first look at the most valuable asset of Software Co., the software. Under the acquisition method, this asset would be measured at fair value. Under a book value method, this asset would be measured at its existing book value, which would reflect the cost to develop the software, but would not reflect its real value. Furthermore, applying the acquisition method, IT Co. would recognize all identifiable assets and liabilities of Software Co. and measure them at fair value, including its brand name. In contrast, a book value method would only recognize assets and liabilities that are already recognized by Software Co. and would report them at the existing book values. Finally, applying the acquisition method, the difference between consideration paid and fair value of identifiable assets and liabilities acquired would be recognized as goodwill, which would reflect pre-existing goodwill in the acquired business and any combination synergies. In contrast, in a book value method, the entire difference between consideration paid and book value of assets and liabilities received, in this case 440 currency units, would be reported as a reduction in equity, which doesn't really provide useful information about the values exchanged in this transaction. So in other words, a book value method does not provide transparency that would allow non-controlling shareholders to assess whether the acquisition is a good deal for the receiving company and to assess subsequent performance relative to the price paid. So just to conclude, from the point of view of non-controlling shareholders, it doesn't really matter that IT core and software core are under common control. For non-controlling shareholders, this transaction affects their existing stake in IT core in the same way as any other business combination. And for that reason, fair value information about software core is most relevant and comparable with information about any other business combinations. And the acquisition method thus provides a transparency and accountability that would allow non-controlling shareholders to both assess the receiving company prospects for cash flows and to assess management stewardship of the receiving company's resources.
Thanks, Julia. Let's just stop there and take a look at some of the questions again. Just to start off with, it's interesting listening to the feedback. And we can see one of the most crucial elements in this entire discussion paper is clearly around which of these methods you apply and at which point. Now, one of the things we hear in accounting a lot is people are always telling us to look at the substance. Has the board considered substance when they look at business combinations under common control?
Yes, thanks, Bruce. And that's another common question that we tend to get on the discussion paper. The board did consider substance, and in the board's view, business combinations under common control always have substance for the receiving company. And this is because in a business combination under common control, as in any other business combination, the receiving company obtains control of the business that it did not control before the combination. So from that point of view, they always have substance. But in addition to that, in a situation where the receiving company has non-controlling shareholders, this transaction is the acquisition not only for the receiving company itself, but also from the point of view of those non-controlling shareholders. And this is because as a result of this transaction, they acquire residual ownership interest in the transport business. So even though ultimate control by the controlling party does not change, ownership interests in the transport economic resources do change, and therefore the transaction has substance.
Thanks, Julia. Richard, I wanted to put a question to you. We obviously hear about how this impacts on people like private companies. Now, are there advantages in private companies in applying, for example, the fair value method versus the book value method?
I guess it's a hard question in terms of advantages. If you're thinking about the benefits to the investors, then it would probably depend on the composition of those investors, which is why the board is very focused on non-controlling shareholders. So if it's a wholly owned company that does not have non-controlling shareholders, so the controlling party is effectively the only shareholder, then they probably don't need that fair value information, and it could be quite costly to prepare. Whereas if there are significant non-controlling shareholders, then they potentially would benefit from having the acquisition method. And that being said, and I think Julia touched on this earlier, there are some people, even with wholly owned companies, who would like a step up to fair value, potentially a so-called fresh start with all companies moving up to fair value. That's not something that would happen with the board's decision tree as it stands, because fresh start typically don't exist in IFRS. Although we are hearing in some cases that could be useful pre-IPO. It's not the most common thing we're hearing, but we are hearing that from some stakeholders that we talk to.
Thanks, Richard. I guess one of the interesting things there is that, if there are people out there who think that this is something that we should be looking at, make sure we hear this in the comment letters. And I think that'll be quite important. Julia, just one question I wanted to hand back to you. Why is the board not suggesting the acquisition method for companies that have publicly traded debt? Debt investors, are they not similar to non-controlling shareholders?
Thanks, Bruce. And in fact, as already pointed out, we are hearing this suggestion from some of the stakeholders in our initial outreach activities. So the reason the board did not propose the use of the acquisition method in situations where debt investors are affected by the transaction is based on the initial outreach that we conducted with users of financial statements in developing the discussion paper. And what we have heard in that initial outreach is that debt investors do not really need that fair value information in credit analysis, and that the information that they focus on, information about cash flows, is not largely affected by whether the acquisition method or a book value method is applied to account for business combination under common control. Furthermore, if the board were to require the use of the acquisition method when debt investors are affected, then arguably the acquisition method would need to be applied in all or almost in all cases, because all companies will have at least some lenders and other creditors. And it's hard to see why information needs of holders of public debt would be different from information needs of holders of private debt. But again, this is something we are hearing in the outreach activities, that perhaps the acquisition method is appropriate in public debt scenarios. And this is something we are exploring in our further outreach with users of financial statements.
Thanks very much, Julia. Well, we've looked already at obviously which method to use. I think now we're going to delve into each of those methods. And we're going to start off by taking a look at the board's view of how to apply the acquisition method. So, Richard, I'm going to hand over to you.
Thanks, Bruce. So, as we explained earlier, the board's preliminary view is that in principle, the acquisition method would apply as set out in IFRS 3, because non-controlling shareholders are affected in the same way as they are in any other business combination. But there's a special feature that is not present in business combinations between unrelated parties and could be present in business combinations under common control. So because of that special feature, the board's suggesting that if there's a bargain purchase, the nature of that is a contribution to equity. So the receiving company should recognise a contribution to equity instead of recognising a gain. In terms of disclosure as well, the board's concluded that because these business combinations are under common control, there are related party transactions, and so IAS 24 would related party disclosures would apply, and so there would be additional information about the transaction price, and the board would look to provide application guidance on the type of information that would be disclosed about the transaction price. I will hand it over to Julia again to share the initial feedback on this topic.
Thank you, Rich. So if you think about the board's preliminary views on how the acquisition method should apply to business combinations under common control, there are essentially three main components to the board view. So first of all, it's what to do in circumstances where there is an overpayment and should an entity be required to identify, measure, and separately recognize a distribution. Second is what to do with contributions, so scenarios where there is an underpayment. And finally, what to do with disclosure. And I think it's fair to say that in our outreach activities today, no one really disagreed with the first and the last component of the board's views. So no one disagreed with the distributions and disclosure. So one topic that does generate a lot of discussion is how to account for contributions. And in particular, some stakeholders agree with the board's preliminary view that any underpayment should be recognized as a contribution to the receiving company equity, and agree for the reasons set out in the discussion paper. Some stakeholders believe that any underpayment in a business combination under common control should be recognized as a gain in profit or loss, as would happen applying IFRS 3 to a business combination between unrelated parties. And finally, some stakeholders argue that in some cases in business combinations under common control, it would be appropriate to recognize any underpayment as a contribution, as the board has suggested, and in other cases, which they describe as a lucky buy, they believe that the underpayment should be recognized in profit or loss, as would happen under IFRS 3, However, it is not really clear how to distinguish a contribution from a lucky buy scenario in a business combination under common control.
Thanks, Julia. Let's just stop there again and take some of the questions we've had. The first one I wanted to ask to you is, why is the board suggesting that the receiving company should recognize a contribution to equity, but not a distribution from equity?
Thanks, Bruce. And that's probably one of the most common questions we receive on how to apply the acquisition method. And some stakeholders refer to it as lack of symmetry in the board's preliminary reviews. And what I would like to highlight here is that there isn't really a lack of symmetry. And in fact, what the board is proposing is based entirely on the logic and on the existing mechanics in IFRS 3 today. So if you think about it, in a business combination between unrelated parties, you can also have an element of overpayment. However, IFRS 3 does not require companies to identify, measure, and recognize separately from goodwill any overpayment in a business combination between unrelated parties. And this is because the board concluded in developing IFRS 3 that it would be impossible for a company to identify and measure any overpayment separately from goodwill. So instead, any such overpayment would be included within initial carrying amount of goodwill and would be subject to subsequent impairment testing. So exactly the same logic in the board view applies to business combinations under common control. Even if an element of overpayment is present, it would be impossible to identify and separately measure that overpayment. So for those reasons, the board suggesting the same approach as for any regular business combination, where the entire difference, the entire excess of the price paid over fair value of acquired assets and liabilities is recorded within goodwill, and then goodwill is subsequently subject to impairment testing. In contrast, IFRS 3 already today requires recognizing any excess of fair value of assets and liabilities over the price paid as a gain in profit or loss. And the board suggesting exactly the same approach in a business combination under common control, except the board argues that this difference in a common control scenario is not a gain that should be recognized in profit or loss. Instead, economically, it represents a contribution to the receiving company from the controlling party, and therefore it should be recognized in receiving company equity.
Thanks very much, Julia. We've also had a question coming in asking the following. It says, how would the receiving company account for a transaction where it purchases an asset from the transferring company at fair market value and records the asset at book value? How would this be a distribution from equity? Richard, do you want to answer that?
Yeah, I'm happy to. I think this relates back to the previous section. So the project that we are talking about today is just focused on business combinations under common control. It's looking to address the scope exclusion that exists in IFRS 3 today, where business combinations under common control are scoped out. The question that's come in is about a purchase of an asset, a real property. So if this is just a purchase of an asset and it's not a business, then we wouldn't be looking at IFRS 3 and that scope exclusion. Presumably it would be IAS 16 if it's a real property asset. And so what we're talking about today would not affect the accounting for that. In terms of the outreach we're having, some people are saying that common control obviously covers a broader spectrum of transactions, not just business combinations. So some stakeholders have asked whether we would look at other types of common control transactions, so real property or investments in associates and joint ventures. But those at the moment are not part of this project. And in fact, if you think that the ISB should be looking at a broader spectrum of common control transactions, then that would probably fall under the agenda consultation, where we'd really value that feedback on what the board should be prioritizing over the next 5 years to look at wider common control transactions if you think that is needed.
Thanks very much, Rich.
If I could add to this quickly a little bit from the history of the project. So the board actually considered explicitly at early stages of the project how narrow or how broad the scope of the project should be. And in particular, the board did consider whether the project should focus just on transfers of businesses under common control or common control transactions more broadly. And the board did observe that other IFRS standards, unlike IFRS 3, do not contain any scope exclusions for transactions under common control, and therefore for other common control transactions, companies would be expected to apply relevant requirements in existing IFRS standards.
Thanks, Julia. I mean, I guess this is always the risk, isn't it, with any new project, that when we start unpicking these issues, that could increase the scope so much that we actually never get to answering anything. With that, let's move on to our last topic for the day. I'm going to hand back to Richard, and we're going to look at how we apply the book value method. So, Richard, over to you.
Thank you. So, as I mentioned in the introduction, there is not a single book value method described in IFRS standards today, and so there is significant diversity in how book value methods are applied in practice. The board reached a view that a single book value method should be specified in IFRS standards, and on screen you can see a summary of the board's views. For a lot of those areas, we tend to hear broad agreement with the board's views, but I'll focus on the two areas that we kind of have the most debate around, which are the two areas in red. So the first one is the assets and liabilities received being measured at the book values as reported by the transferred company. And the second part is combining companies being combined prospectively from the date of the combination, which is similar to what we see in IFRS 3 with business combinations. There obviously will be a lot more detail in how a single book value method would be designed, and so the board will consider those more detailed aspects later, in particular once the foundations of the model and when each method would apply, because we need to really think about when each method would apply to then decide exactly how each method should apply and what the information needs would be for the different users. I'll now hand it over to Julia to share initial feedback on those two areas that I mentioned, which are which book values to use and pre-combination information.
Thank you very much, Rich. So starting with the first area, which book values should be applied. And with some of the other topics that we have highlighted today, there is a significant diversity of views. So some stakeholders agree with the board to use the transferred company's book values in applying a book value method and agree for the reasons set out in the discussion paper. Some stakeholders think that in different circumstances, different book values may provide most useful information. So for example, if the transferred company had been recently acquired in an external combination. So these stakeholders point out that sometimes companies are acquired into the group and then are moved around within the group. And so they suggest that in such cases, it may be more useful to use the values at which the company entered the group. So to use the controlling party book values rather than a transferred company's book values. And finally, those stakeholders who suggest that a book value method should apply to all business combinations under common control, they also tend to suggest that using the controlling party's book values is appropriate in all cases. And this is because they tend to emphasize the controlling party role in the transaction and view the transaction generally from the controlling party perspective rather than reporting entity perspective. And finally, in terms of initial feedback on pre-combination information, so some stakeholders agree with the board's preliminary view to use a prospective approach in reporting business combinations under common control and agree for the reasons set out in the discussion paper. Under a prospective approach, the transferred company is only combined from the combination date, and pre-combination information of the receiving company is not restated. So this approach is exactly the same as under the acquisition method in IFRS 3. Now, some stakeholders think that pre-combination information about all combining companies is useful and it should be required, but only in the notes to the financial statements and not in the primary financial statements. And then finally, some stakeholders support a retrospective approach in the primary financial statements, at least in some cases or even in all cases. Specifically, some stakeholders argue that a retrospective approach on the face of primary financial statements should at least be permitted in an IPO scenario. And under such a retrospective approach, pre-combination information of the receiving company is restated to include all combining companies from the beginning of the first period presented, as if those companies had always been combined.
Thanks, Julia. And so now you've heard a summary of what we proposed in the discussion paper. If you've got any last questions, please do type them in. We've still got some time to look at them. Just a couple of questions to pose to start off with. Richard, what happens if the transferred company does not prepare financial statements using IFRS?
This is very much one of those areas that I said the board will consider further as we move into the next phase of the project. So it is definitely something that we are aware of. And in fact, it's not unique to using the transferred company's book values. Even if we said you would primarily look at the controlling party's book values, in some cases, you might not have IFRS numbers at a controlling party level either. So, for example, if the controlling party was an individual, if the controlling party used a different GAAP, say they're based in a jurisdiction where other GAPs are commonly used rather than IFRS, or maybe if it's a carve out rather than an existing incorporated entity. So the short version is that we'll consider it at the next phase. We are aware that it could be a practical issue, and so we'll look at things like practical expedience to try to make that a little less costly, particularly conscious of the cost benefit that we're looking at when we in the situations where a book value method would be applied.
Thanks very much. Julia, just to ask you on there, where in equity would the difference between consideration paid and the assets and liabilities be presented?
So that's one of the areas which the board is not suggesting to prescribe. And this is because the board generally does not prescribe presentation within companies' equity. This is something that often is addressed by local requirements and regulations. So there is no specified requirement. However, the board is suggesting that a receiving company should disclose information about the amount of difference recognized in equity and where in equity it has been presented.
Thanks very much. Richard, just to pose another one to you. Why is the board suggesting different methods for companies with publicly traded shares and those that are preparing for an IPO?
The reason would be that when somebody is an existing non-controlling shareholder, so when the company's already listed, then they've already chosen to invest in that company. And what's happening here is that the business combination is happening. And it is under common control, but still it's a business combination. It's a new transaction. There's the new resources that are being acquired. So as Julia mentioned earlier, those existing non-controlling shareholders have the same interest in this as they do for a business combination between unrelated parties, and fair value information would be useful. If we think about a situation that's pre-IPO, so the transaction's happening kind of to prepare and to get the group ready to IPO, at that stage, the investors haven't invested yet. So the investors will be making an investment decision based on the entire business that's going for a listing. So whether that group has already been sat in the perfect structure for years and didn't need to undertake a transaction, whether one business is brought under another or it's undertaken the other way or a new coast put on top, however you structure that, it's the same economic resources that a prospective investor would be investing into in an IPO. And so they should be getting that same information to look at the entire business. They're not just looking at this transaction.
Thanks very much, Richard. Just one other question for Julia. It says, in terms of assessing whether the transaction would affect non-controlling shareholders of a receiving company, how would holders of convertible debt instruments be treated under the board's preliminary views?
Thanks, Bruce. And that's one of the common questions that we get. And it's not only a question about convertible debt, but other complex instruments, putable instruments, share options, etc., and also about more complex capital structures. And what I would like to highlight here is that at this point, the board has only considered sort of basic and plain vanilla scenarios. And this is because it is important to first build the foundations of the model and to sort of build and identify consensus on the main building blocks of the future model. And once those main building blocks are confirmed, then the board would be in a position to consider further detailed aspects of that model. So this is to come at the next stage in the project.
Thanks very much. With that being done, I think that's all the questions we've got. So let's just wrap up the session. Just look at the timeline. The discussion paper is open for comment until the 1st of September 2021, and the board should plan to start discussing that feedback probably last quarter of this year. We do invite you to comment on the board's preliminary view, so please do get your comment letters in before the closing date. For more information on the project is available on our website, and there is a host of educational resources you can also have access to. With that being said, I want to say thank you to Julie and Richard for presenting today, and thank you to everyone who joined us and participated in this. We hope you found the session useful. Take care.